Okay, good evening to all of you all. I will start the session. I have wait for 6 minutes for students who it's joining as help for them. Then the 6 minutes wait. Then we will start. This is the discussion of your pre-scene with reference to the SL3 and to achieve your question 3 in 50 marks. Then it's a 30 marks totally with the computation and the balance 20 marks. It's for the writing part, maybe tax planning, tax administration, case law provisions, business decision making, whatever. Then everything it's there in your paper with reference to that 50 marks, okay? Whatever they are not all, whatever the area, it can be included. Then this is totally what we are looking is based on the pre-scene information, what is the help which we can obtain for our unseen, which is at our examination, okay? Then let me start with the discussion of the okay. Discussion. Then let me share. If now let me do the session. Then after that, whatever the issues, whatever the questions you all have, end of the session, then you all can ask. Okay. If it is highly critical, then while in the discussion, I will look at the chat box and I will answer. But it's prefer that you can put any questions to chat box, okay? Then I will answer those in after completing the session. And the verbally, anyone can ask the questions. For that also, I'm requesting for you all to wait until the end of the discussion. Then after that, we can discuss whatever the things leisurely, okay? Then let me start off in the discussion of the pre-scene. Then this is not textual, this is what we have prepared now. Then this is what your document, which is the pre-scene, which is Quick Eats PLC, which is one of the lovely company. And again, It's Been Eats, which is one of the lovely topic for you all of us very food lovers. Then anyway, then therefore, this is totally a real world example, which we have. Then it's with us, it's in our blood, then it's really easy for you to understand the structure of the company. Then we are used to live in this particular system now in the country. We have, it's very much familiar us. Then therefore, this is our company until our examination, which is Quick Eats PLC. It's a coded public company. Then in this coded public company, there are issues. There are some relevant points for SL3, which is taxation. Then we need to look at what are those. This is totally discussing for help for you to face your unseen, your exam paper in a very good, in a comfort zone. That's the understanding. Well, what we are discussing is this is just one angle which one person can see. Okay. Then here, let me come to the details of the pre-scene. What I'm doing, this is your original pre-scene document. And in here, I'm using this and this is the main document. I'm going to discuss with you all. However, when it needed to me, I'm coming to this and discuss the things in here and again moving to this. I think it's clear. Then I come to this, which is the our company, overview of the company. I need to look at, this is my company, Quick Eats PLC, QEP. Now you can see the real world examples are there for all three companies. We have not only Quick Eats PLC, we have Quick Eats IT Private Limited, which is the company totally managing the IT, which is the app, and the Quick Eats Riders, the rider is there to connect the customer and the retail, the food outlet. The person who link is the driver through the delivery. But before that, through the Quick Eats PLC, through their app, their link, there is an app, and their link, the customer and the retail or food retail outlets or food or restaurant. Then in the physical delivery part, it is doing by the driver, which in the Quick Eats Riders Private Limited. Then this is the overall structure of the company. Then don't forget, this is a group of companies. Then this being a group of companies, always you have to think about, okay, being a group of companies, I have some tax issues, then I need to move for that. What is that? The ownership or a shareholding structure of the three companies we need to look at. Then the shareholding structure of the group, why we need to look at the helicopter view of this group. The reason is this. What is the reason? Reason is to identify the tax issues which can be come up at your examination. In here, which is we have QVP, which our company, and the Quick Eats IT Private Limited and the Quick Eats Riders Private Limited. Then this is the ownership structure, but now you can see these three are linked together. Why these three are linked together? The reason is Quick Eats IT Private Limited, 100% ownership is with QEP. And not only that, when it comes to Quick Eats Riders Private Limited, the 100% of the ownership is with the QEP. Now, it's a group. QEP has the two fully owned subsidiaries as Quick Eats IT and the Quick Eats Riders. Then due to this reason, you can see without having this platform, without having relationship between these three companies, they cannot survive in their business model. Therefore, obviously, there are transactions in between these associated persons, very clearly associated by the share capital, by the ownership capital, and the control board. Then in here, therefore, under section 196, under definition of the associated person, entity, and the entity and the person. It's associated, and again under transfer pricing, one of the hot topic in that the transfer pricing, according to transfer pricing gazette notification, these three companies are the associated persons. Then if there are transactions in between associated persons, then the exposure of the transfer pricing is there, but subject to the conditions. Then here, one of the overview essence from this scenario, which it's been a group of companies, then we need to look at on this one, transfer pricing issues. If it is applicable, it's section 77 application, which is the domestic transfer pricing. It's not on the international transfer pricing, but I don't know. Then in the being associated persons, always we have discussed there are transactions. However, if there are assets transfer, which continuously tested in your paper, assets transferred in between associated persons in a different kinds of the assets, which is maybe trading in stock, depreciable asset, investment asset, what is the tax treatment under special realization provisions, then we need to look at if the asset transferred in between associated person, what can be happen? Not only that, the transfer pricing. These are two issues which it being a group in a commonly. Then that common issues may be impact us also. Then that is on the current group structure and the importance of the group structure for us. And let me come to take our company, and I need to look at the overview of the company. Company overview, which is Quick Eats PLC. The name of the company, Quick Eats PLC, before that it was a private limited and IPO done, and now we are in the quoted public company position. Nature of principal business activity, first food delivery platform. Then connected fast food outlets, consumers and the couriers through mobile platforms. Then it is there are many stakeholders. Then there are linked to the mobile platform that is there. This in the page 2 of the page 2 para 3 in the original piece. And date of incorporation is in the 2012. Date of listing is 2020. Shareholding is structured before and after listing. Then this is on the ownership before listing, and this is ownership after listing. What's the dilution part happens from the Mark Pereira and the Steve Pereira, and the shares the diluted, and the public has purchased the shares. Then this is on the shareholding structure being a quoted public company. Then number of shares 300 million shares, and the value of the total stated capital 6 million. Now, where those information provided, it's very clearly in your this one. You can see a number of shares in millions rupees. Rupees, the value is given. The number of shares in millions, then it's not rupees, then it's 300 million. The entirely, even for 23-24, this is in the comprehensive income statement it has provided. Then it's the number of shares 300 million, and the value in your financial position, which is in here. In stated capital, you can see it's the 6,000 million. Then in that, we have 6,000 million value of shares, and we have number of shares 300 million. Then we have the per share here, which is rupees 20. Then that's how it has taken. Then this is on the overview of the company. Now I need to come, being the Quick Eats PLC, then tax perspective I need to look at. If it is a company, then in a resident company, what are the tax implications we need to know? The implications on the Inland Revenue Act and the implications on the VAT. Here, the Inland Revenue Act up to latest amendment, which is 8th amendment done on 8 September 2023, up to that, the changes applicable. And the relevant gazette notification, I think now you all have all the acts with you and the relevant gazette notifications with you. Even VAT, even in the Inland Revenue Act. Therefore, be prepared for exam. It's a very important thing. Even the open book referential materials are one of the critical success factor for you to prepare for the exam and be in the comfort zone. It's not that if you have brought that all the documents, gazettes, act and everything, it's a 3 hours and 15 minutes. You cannot check those, I'm pretty sure. The 100% you cannot look at on that. But it's a comfort zone. Then you have a confidence in your mind. Okay, I have all these things with me. Then when it's needed, when it's required, only I'm looking these things. That you should have these documents with you. Therefore, this is one advice. Then this relevant documents you should have. Anything, it can be tested. Then this is on the tax perspective. I'm starting from the tax perspective in income tax. Then here, income tax rate, you know, is a 30%, including gain from realization of an investment asset. The rate is 30%, no change. It is on the assessable income and coming towards the taxable income. Then when it comes to this, the dividends, the obvious adjustment in your paper, which is in on dividend income, on distribution of dividend, if it is there, you should need to know from 1st January 2023 onwards, it's a final withholding tax. The final withholding tax applicable on what? Dividend distributed out of profit. It's a liable part. Then it is 15%. But this is subject to exemption. What is the exemption? Dividend distributed out of dividend income received to another resident company, then it is exempted. Then you have, I think you have that all particular knowledge with you. Okay. Then the next one, this is on dividend and this is on the corporate income tax rate in taxable income. And now come to tax implication. Now I'm taking possible issues out of your given original PC. Then under the tax perspective in QEP, the possible issues in that very clearly given in page number 3. I am referring to this one. In page number 3, which is the expansion strategy. This is I need to focus on this expansion strategy little bit in our discussion because it's highly important. Then when it comes to this expansion strategy, there are their own thinking process which they are firmly believe that this is the successful approach for go for the expansions. Okay. Now let me come to based on the thinking pattern, then what is the tax implication as per information provided in placing. Then here, which is the strategic thinking in page 3, it has given the overview of the expansion strategy. What is that? Board directors think that the quickest option to enhance value is to be acquired existing business or existing businesses rather than building new business lines from scratch. So without starting from zero, they are believing they can go for the acquisition. Then due to their which is linking for food, they like to consider options such as acquiring a restaurant chain or lean luxury city hotel. We have 2 options which it has given, which is the Colombo Plaza restaurant and city hotel and the Palace of Seafood. There are 2 options available for QEP. Now we need to look at on these 2 exhibition options, what can be a test. Now again, even in the pre-scene it has given, they are going to go for exhibition, but suddenly at the answer it can be provided. They have realized that the exhibition options are not much successful. Then they have thought to incorporate a new company and do this and that. Anything can be happen, then you have to prepare. Then here, but in the pre-scene, it's a 2 options given as the exhibition. Now, what is the danger of the exhibition? I need to look at on both angles. There is acquirer and there is acquiring. Then therefore, this discussion a little bit going longer. Okay. Then come to this. And why they are doing this thing? The reason, the SPU's main intention is to maximize shareholder wealth. To maximize shareholder wealth, we have to go for the profit maximization, then and the increasing of the capital efficiency. Then whatever which is quick options which they can go, then they may be very happy on those as per their will. Then we will look at the 2 options given in the pre-scene. What are those 2 options, which is the Colombo Plaza restaurant and city hotel and the Place of Seafood. All the details of these 2 exhibitions, it has given in here. These 2 details of this 2 restaurants, the city hotel and the Place of Seafood. We will come to those later. While then for this one, option 1, Colombo Plaza, and option 2 is the Place of Seafood. Now come to this. Let me analyze one by one on this. It's a same continuation I'm doing. Tax implication of acquiring strategy. Now, when we are looking at tax implications, we need to look at after acquiring, what's the tax liability which I have to pay? Then, being a company, what is the tax liability? That's the second thing. Then, therefore, I need to look at on these areas which refers to the exhibition. Not only that, the way of financing is critical. Then it is silence in this question. Sorry, in this precinct, it is silence. How they are going to fund it for this particular exhibitions, it's not given. Then it's better for us to look at these things. Then come to this, in income tax, in the tax implication of the exhibition strategy, in the income tax, can we go for the investment incentive? This is our investment. Can we go for investment incentives? For us to go for investment incentives, we have two options. One is we can go for second schedule. One is we can go for sixth schedule. What are the specialties on these two schedules? In the sixth schedule, it's a temporary concessions. Temporary concessions on investment, which is in the depreciable assets, not in the expansion of the existing business. Then we shall not invest in the intangible assets. The total value, which up to $3 million. The US dollar is always a parameter only. Then even we can invest on LKR, INR, whatever, but it should be equivalent to the US dollar. Then that's on the sixth schedule, which is the based on the limit of the investment. These two schedules will be different. Then in the sixth schedule is a temporary concession. It being a temporary concession, that temporary concession period has been abolished by today. When it comes to today, it has abolished. It has abolished on 31st March 2024. The temporary concession it has given for the 6 years period. Then from the commencement of the Inland Revenue Act, number 24, 2017. Then here, which is, it has commenced from year of assessment 1819, 1819, 19, 20, 20, 21, 21, 22, 22, 23, and 23, 24, which is your testable year of assessment. It's the last year of assessment. This temporary concession is available. Then for the future decisions, which you are going to take from 24, 25 onwards, don't comment on using this sixth schedule. That's very, very important. Don't comment on using this sixth schedule because the enhanced capital allowances, the particular investment incentives, temporary concessions given, especially in enhanced capital allowances, it was over. The current year it is there, which is your testable year, but for the future it's not there. That's the one thing. And the second thing, the second schedule. In the second schedule, again, we are looking for investment incentives, and it's in a permanent nature. That means there is no time limit. Limitation period is not there. But when we are going for second schedule, it is starting from exceeding $3 million, and it's going forward a particular limits. For this, again, you have to invest in depreciable assets other than the expansion of the investment asset, and it shall be benefited in Sri Lanka, and other than in the intangible assets, and the US dollar, it should exceed $3 million. Then these conditions are there. Now the question is, we have to go for acquisition. There is an existing business, we are going to take over, acquire that. Under that situation, is it a new undertaking? No. It is existing undertaking, which we are parking our money and we take the ownership. Under that situation, either second schedule, either sixth schedule shall not be applicable. Anyway, sixth schedule for my future decisions I shall not use. Then come to this. Can we apply sixth schedule law? A second schedule answer is completely no. Under this, acquiring of the existing business line, we cannot check. And the sixth schedule come to one by one explanation, which I have provided. Sixth schedule, enhanced capital allowances after 31st March 2024 is out of scope. Therefore, under any situation, shall not suggest for future tax benefits, not for this year, not for 23-24, but for future tax benefits under enhanced capital allowances, it shall not be suggested. Then the second one, which is the second schedule in enhanced capital allowances, this is an acquisition of existing business and not a new undertaking. Therefore, the benefit of the enhanced capital allowances shall not be applicable. The benefit of the enhanced capital allowances shall not be applicable. Any questions you all can put in the chat box. Huh? Then this is on the first thing, application of the investment incentives. Unfortunately, no investment incentives. Now come to next. I'm looking from the angle of the QEP, the Quick Eats PLC, if they have done the acquisition. Then the next one, which is the income tax, the application of income tax. Unfortunately, it's two hotels or two restaurants. One is a city hotel, other one is a restaurant. Anyway, we don't have any the benefits on tax rate, the flat tax rate, the regressive tax rate is there, which is applicable tax rate is 30%. Then dividend subject to exemptions, it is 15%, which is a final withholding payment. If we have acquired, okay? Acquired, these are the implications. Now come to VAT and SSCL. Then why only the direct tax? Why don't we look at on the indirect taxes? Then come to this, the SSCL of the indirect tax. It's a direct tax. Then I have made that statement compared to the income tax. Then here, in the VAT and SSCL, in VAT, what has happened for a value-added tax? Then for this, the QEP and these two restaurants, I don't know whether they have registered for VAT or not, but in your original document of paying, you can see the details of in the annexures, the details given for the, in the forecast for a possible acquisition, the relevant details given. Then here you can see it is the earning before interest and tax. We are looking for earning. In both cases, this is 3,116 million. And here, which is 1,345,000. Then again, everything is in millions. Then it seems to be, which is for have this kind of the EBIT, then definitely their revenue levels are so high. Then I assume that based on the details given here, they are good in their revenue. Then obviously they may be registered for value-added tax. Then it's a threshold. I don't know, but I have analyzed by which in the preceding information based on the EBIT details provided in Annexure 3 and Annexure 4 under the forecast. Both restaurants are liable for VAT and SSCL. What is the turnover threshold for VAT? What is the turnover threshold for SSCL? The VAT up to 31st December 2023, it was for a taxable period of 1 month or taxable period of 3 months. Then it is the 20 million. And per annum, it's likely exceeds or likely to exceed, it's rupees 80 million. And what has happened from 1st January 2024 onwards? Then, from 1st January 2024 onwards, the threshold has changed to, for a taxable period of 1 month or 3 months, it's 15 million, and per annum it's 60 million. It exceeds or likely to exceed. Then the same thing for SSCL after 1st January 2024, but for before that SSCL liable threshold, it was the 30 million per quarter and 120 million per annum. That was there. VAT rate. VAT rate has changed from first up to prior to up to 1st January 2024 15, and after that 18% for your question to the value added tax. It can be now you should have a good eye opener if your taxable period, if it is tested Jan, Feb, March, then 18. Prior to that, if it has tested whatever from 1st April to 31st December, then it's a 15%. Please remember these things. And when it comes to SSCL, it's liable. In these 2 restaurants, they are doing the providing of service. Then SSCL is liable at 2.5%. If the turnover tax, it will be applicable on the turnover, the different levels of the turnover, the different values of the turnover liable for SSCL at the rate of 2.5%. Okay. Then income tax liable, if there is a dividend, it's liable. VAT liable and the SSCL liable, no concessions. Okay. Then next, here, now I need to look at a different angle because it's now based on the information, which is the tax concessions. Those things are very rare. Now, I need to think about a little in a different manner. The way of financing, which is the reason is silence, which is in way of financing. I need to look at the tax implication of the way of financing. Then here, the methods of financing, we can go for equity financing or we can go for debt financing. When it comes to equity financing, we are quoted public company. If we are good, then we can go for subsequent share issue, but no information given. Now the hidden part is exhibitions given, but on exhibition, how they are going to finance is silence. Then here, if it is going for equity financing with the share issue, what is the cost? If you are my shareholders, if I have issued the shares to you, then ultimately I have to give dividends to you. Now the dividend, Lamai, please remember, dividend is always we are distributing from the profit which we have already paid taxes. Then we are distributing dividend out of the profit after tax, which is my retained earning. Then yes, I be the recipient. For me, it is final withholding payment. That's okay. But from the company side, we have paid a 30% tax on that. And from that, we again paying 15% on behalf of shareholders. And I'm giving net figure to them. Then that is the implication on the dividend. What is the cost distribution of dividend? The tax application is 15% final withholding payment out of profit which the company paid corporate income tax. Don't forget that the rationale. Okay. Then this is the dividend. Now come to next one, the way of financing, debt financing. In here, which is the tax implication on debt financing. Now, what do you know? The common statement you all have, which I have put in here also, interest is tax deductible. Then now it's one of the earliest, no, it's not as so in each and every situation. It's not tax deductible now. There is a pointer for us, which is section 18. The section 18 that talks about that, okay, it's tax, the finance cost is tax deductible. But it should be up to your stated capital plus reserves into 4 times. Whatever the amount maximum on that, you shall not claim the that particular finance cost. Now that red alarm is always there. Now I thought it's a little bit good for us to analyze the pre-seen information and look at how it can be happen for us. Then here, whether the interest is for our case, is tax deductible or not. Then here, the application of section 12, the finance cost deduction subject to section 11, subsection 1, which is the main deduction rule. If that incurred for the production of income, that's the condition. Then, if I have borrowed money and I have invest it for the in asset, and asset used for the production of income during the year, I'm good. And not only that, I have borrowed money and I totally use it for the production of income. Then, of course, I'm so happy under section 12, I can deduct this. Okay, but there is the rule for us, which is I need to go for application of the section 18. What is the section 18 it has given? It has provided a limit. What is the limit? The stated capital plus reserves into 4 times, but other than the revaluation reserve, which is reserve, which it's really happen, really realizing at the point of disposal of the assets. Then therefore, something notional, no, we are not taking, remove that, and only take the stated capital plus reserves. Into how many times? 4 times. For your reference, I have given this provision. Now, this is not the thing. I need to come for this. The application that figures, which given in the pre-seen, this is again for your 30 marks question. The computation part, this is equally applicable. And again, when it comes to your this decision-making part, also this is applicable. Then here, what it has given, the debt financing, I need to go for real figures given in pre-seen. According to the maximum borrowing limit, as per the financial statements for the year ended 31st March 2024, it's a stated capital plus reserves into 4 times other than revaluation reserve. Now let me come to this, which is the maximum borrowing limit I'm going to compute. Then here, stated capital is this, and this is for my company 2024. We are not computing tax for the group. We are computing for the Quick Eats PLC, the company. Then here, stated capital, a revaluation reserve, I don't count that, and the retaining earnings, the 3,435,000. This 2, and I need to multiply this by in 4. Sorry. Then here, it is the maximum borrowing 6 million plus 3,435,000. It's millions at 4 times. 37,740 million is there. Now come to the actual borrowings. The actual borrowings, which it has given, interest-bearing borrowing, the long-term, lease liability, then here we have the right of use assets, we have the right of use assets. Then under that situation, the lease liability, not much details in the pre-seen. Then here, which is interest-bearing loans and borrowings in short term, 582. And there is a lease liability again for this one, and whether it's a ROU liability or we don't know. Okay. Then here, which is the for this one, actual borrowing is a non-current liability, interest-bearing borrowing. Here, current liability is interest-bearing borrowing. I have not considered the leases because I don't have information. Then the actual borrowing is what? According to here, 4,103 million. Then Lamai, we are good. We have not exceeded the maximum borrowing limit. If it is so, that fundamental rule which you all know, interest is tax deductible is correct. Then note, according to preceding information, if section 12 satisfies interest cost other than interest cost on ROU liability can be deductible. Maximum borrowing limit is according to this more than the actual borrowing. If it is so, you can obtain the tax benefit out of which your decision on the go for the financing of these exhibitions through the borrowings. Okay, and the next one, which is the next method of financing, we can go for the free cash, which is available for us in the financial position. Here we go. We had in current assets, cash and cash equivalents, 1,212,000, but I don't think it's a feasible option. We don't know. Then which is for this one, if it is so, no tax implication in that is just only the opportunity cost, but no tax implication. Then note accordingly, the most tax effective method is debt financing if isolatedly considered the tax perspective. I'm only looking for tax perspective. If it is so, the debt financing is good. This is on the two options, the tax implications on tax rates and tax implications on the concessions and way of financing, the three ways it has analyzed. Now come to next one, which is under the possible issues. Now we have looked into from the side of QEP. That means us. I need to look at from the angle of these two, the companies, but the question is again, it is the shareholders and the owners, that particular details given in here. Now I need to come for this, which is it's given 50% stake of the business, and here it has given the main shareholders. These two companies, it's the hotel and the restaurant in the private limited companies. Then here, what it has given from the company side, there is a change in of the control happen from the individual two companies, whether we need to look at there is a change in control happen. Due to happening that change, what are the tax implications? Anyway, not only for praising, but also for whatever the questions, even in maybe in a question 1, question 2, this section 64 application is critical. Then let me come to this, which is the second possible issues under strategic thinking. Then what are the tax implications if there is a change of control? Mataneme, not for QEP, but it's for the Colombo Plaza Restaurant and City Hotel and Place of Seafood. Right. For this too. Then in here, what is tax implication on change in control for them? Before coming to these, I need to, I will explain the first paragraph and I need to go for original preceding document. Then here, when the underlying ownership of the entity changes, these are entity includes company, partnership and trust, then we are looking for companies. Then entity changes by more than 50% as compared with that ownership at any time during previous 3 years. The entity after the change shall not be permitted to. This ABCD, before coming to this ABCD, I need to look at on this statement. Under the being the acquirees, these two companies, the possible two companies, then are they going to change their shareholding structure more than 50%. That's the question. The answer is there. Now come to this when it comes to the Colombo Plaza Restaurant and City Hotel. It is in that it's provided the, I'm not reading all the things, but I need to go for this paragraph. Recently, Steve got to know that the main shareholder who owns 70% of CPRH wants to sell his stake in the company. The balance 30% is owned by another shareholder who seems to have an interest in holding share percentage in CPRH. This is the story for the hotel. Now, for hotel, yes, we have the crew, which is, it's a 70% owned. Then it's more than for us, if we are going to acquire this hotel, we have to acquire what's the percentage? 70%. It comes to more than 50%. Done. And when it comes to this one, which is the place of seafood, it's given, there are two owners owning an equal share percentage of place of seafood. One owner is a director who is also the lead chef. The other owner is currently not well and plans to sell his Lamide exactly 50% stake of the business. Then even in the unseen, if it is the 50% is there, this change in control by more than 50% not applicable for this company, place of seafood. But for this Colombo City Hotel, Colombo Plaza Restaurant and City Hotel, it can be applicable. Okay. Then therefore, now we need to look at, this is a real situation. This is a provision of the Inland Revenue Act. Now, if that particular, the Colombo City Hotel, if the, but I don't know in the unseen which other party also willing to sell here. We don't know. But in here, if such situation happen, to now available information is City Hotel. What City Hotel shall not do? The things are which is shall not permitted to deduct when computing the business income. First one, the deduct finance cost carried forward under Section 18. You know, there is always if there is a maximum borrowing limit exceeding, if we have the borrowed actually, up to that limit, the finance cost shall be disallowed. And such disallowable finance cost, we can carry it forward to how many years? For 6 years. And that such carried forward finance cost, we can claim under the unused, which is a finance borrowing limit in the that respective 6 years. That particular benefit it is not provided if the company, which is change the control, it's a more than 50%. Second one, deduction of loss, the possible things. The A and B are the possible, which is that mean it's a any question. They can test these things because commonly applicable. Then the deduct a loss under Section 1 of the Section 19, the deduction of the business loss. Talk about Section 19, subsection 1. Then in the deduction of the business loss, which is the loss carried forward period is 6 years after year of assessment that loss incurred. Now it has not provided. And in the C, which talking about the claiming of the and reversal of amounts, including bad debts in the Section 24, it's a prohibited. And when it comes to in the Section 25, it's talking about the long-term contracts. In that, the reversal of the amount and taking the benefit out of that within their 3 years period given, it is not applicable. This is a situation. Then, however, there is a benefit given irrespective of this A, B, C, D. It has provided this section shall not apply to a partnership or company. For us, it's a company that conducts the same business after change as it conducted before the change, at least for a period of how many years? At least for a period of 2 years. Then, why they are going to acquire this 2 hotels? Then, under strategic thinking, the reason for acquiring of these 2 hotels, keep that hotels in the same business line. They are not going to acquire hotel and change their original business. It's not from the hotel to go for manufacturing, nothing. Then the main reason they cannot start from the zero. Then therefore, they need to have the existing established 2 entities, and they are investing on those, and after that, take the benefit. According to present information, they are not going to change the original model. They are not going to change the original model. Then in here, how to answer? Based on the scenario, information provided in the scenario, apply section 64 requirement, not that what we have discussed. Then you have to read the scenario, and according to pre-scene 70% one and 50% one, probably this going to the 70% part, which is on the city hotel. If it is so, if they are doing the same business, at least for a 2 years period, then this any of the restrictions are not applicable. Then surely we can continue the business with the this kind of the little tax benefits. And again, the reason which the things can be changed. Then in here, in the forecast, you can see the figures. Everything is in a good manner. The losses, I don't know about the which is finance cost disallowed components, but in the forecast on the exhibition, these are in the good figures. Okay. Then you should have to have the eye opener of this section 64 application. And next one, which is in the changing of control, which I have explained to you, 70% and the 50%. Then to apply section 64, changing of control, entity changes by more than 50% as compared with the ownership at any time during previous 3 years. Therefore, as per preceding information, if QEP acquired the Palace of Seafood, the section 64 is not applicable. Then very clearly that particular reasons and the explanations provided. And let me come to next one, the individual income tax. Now I'm still in the possible activation to QEP done for individual companies done. Then why don't we look at the shareholders? They are going to give their shares to another person. There is a changing of ownership of the shares. The changing of ownership of the membership interest of the company. The shares, it's a capital asset. It's used for investment. Then there is what? There is the capital gain tax implication is there. Based on information in the preceding Lamai, these are not what? Listed shares. These are private equity shares. Then what's the situation? We need to, if the individual, if we have look at, there is a capital gain tax application. Come to this, the tax implication on individual income tax. View of the shareholder of the each acquirer. Then Colombo Plaza Restaurant and City Hotel. It's the prospective percentage of share disposal 7. It's a main shareholder. Place of seafood. The prospective shareholding percentage should dispose is 50%. Owner currently not well. Then disposing of privately equated shares. Liable for income tax at the rate of 10% under capital gain tax. How to compute gain? Please go through now in one time. Not last paper, but in December 2022 paper in individual, the capital gain tax, it has tested. And yes, and therefore, this knowledge are very critical to answer for entire paper. Then here, which is how to compute gain, I need to look at the consideration and I need to have the cost. The cost, we have the three components, which is maybe my acquisition cost. Then if it is prior to 30th September 2017, I want to go for the valuation on 30th September 2017 and apply it. And I have improvement cost for shares, no. Then next one, the incidental expenses on acquiring and disposal, acquiring or disposal. And when it comes to consideration, now just we shall not apply the selling price. We have two parameters to check. What are those? Under section 38, it has mentioned in the consideration, the parameters is we need to go for actual selling price, what we have negotiated with my buyer, and I need to compare it with the assessed value. Then assessed value is the value which we need to take from a person who is a qualified valuer. Then in that situation, which is whichever is higher, we need to take. Then under that situation, this particular section is given 37, 38 and section 203 is for the transitional provisions. You need to compute, and the 10% on the capital gain tax you have to apply if there is such kind of thing. However, the disposal of listed shares exempted from income tax under first schedule para H. Third schedule para H, sorry. Now these are not listed entities. Ekalama, it's the two shareholders given. Then it's not the listed public. Then there is not the listed. Then anyway, I have put this footmark for you to have again the comparison in the liable part and the exempted part. This is on the individual perspective, what we can see. Now, that is on the that entire discussion of that possible strategically the options which they are going to do. Now I need to go for a little bit in a different angle, which is looking at each of the separate companies. Why I need to look at each of separate companies, then or if so, I can link those to the relevant part of the pre-scene nicely. Then come to this, for each individual companies in here, these are the three individual company. In that we need to look at on the Quick Eats IT Private Limited and the Quick Eats Riders Private Limited. Then let me come to your document. In here, the relationship is very clearly mentioned. This, okay. This is the Quick Eats PLC is acquired which is being a parent in the Quick Eats IT Private Limited and the Quick Eats Riders Private Limited. Is a 100% stakes are there and it's subject to transfer pricing. Now, I need to look at on these two companies. Then Quick Eats IT, I will take it first, which is here. Okay. Then it's the nature of the company Quick Eats IT Private Limited. Information technology, again, a red alarm in industry for you all. From the side of VAT as well as from the side of income tax. Then we will come to that. Nature principal business activities. This company was established to provide IT services to within the group. Now it's very clearly given, na? It's IT services within the group. There are transactions in between the associated persons, but to apply the transfer pricing, there are three conditions. In that either one, it shall be satisfied. Then here, in addition to providing of IT services to the group, Quick Eats IT Private Limited provides IT services to other companies. Now you can very clearly see, Lamai. In the pre-scene, these details provided not only for me, but also for independent third parties, they are providing services. Then we have, which is our internal price. Not only that, we have the comparable uncontrolled price, which is we can benchmark the price. In the market, in with us, it is available. Okay. Then when it comes to shareholding structure, it's 100% owned by QVP. You all know that now. Tax implication, which is Quick Eats IT Private Limited. There was an exemption for IT enabling services. Cover that when for income tax prior to 1st April 2023 up to year of assessment 22-23, they had that privilege. But from 1st April 2023 onwards, which is from the year of assessment 23-24 onwards, they are liable for income tax from the year of assessment 23-24. And the VAT prior to 31st December 2023, they are exempted from the providing of the IT enabling services. There was a separate gazette, and under that they have exempted. And again, from the earlier itself, from the VAT Act, the locally developed softwares, it's like that, it's exempted. But however, what has happened with the major changes to exemptions under part 2 of the VAT first schedule, in that it's many more things abolished, and now we have little list of the exemptions under part 3 of the first schedule. Accordingly, the VAT exemption given for the IT enabling services, it was abolished from the 1st January 2024. One common ideas on these things are very critical, okay? These are recent changes happen. Then for SSCL, liable, if the liable threshold exceeds, yes, 2.5% is applicable. For them, they don't have the exemptions. Then they therefore liable to pay income tax at normal rate, VAT and SSCL if the threshold exceeds. Now, this is the current position of the, which is Quick Eats IT Private Limited. This is one of the alarming factor which you have to remember. The application of the TP, and we have benchmark price. Then Quick Eats Riders Private Limited, more in a human, which is intervention nature, the company. Then here, name of the company, Quick Eats Riders, nature or principal business activity. This company manages the fleet of drivers, driver recruitment, training, management, and any other issues related to drivers are handled by Quick Eats Riders, which given in the page 8. I'm not again going for original pre-scene. Now the question. We are dealing with the drivers. There may be issues with that in that management of the people. There may be issues which directly impacted to the tax. Then we will look at one by one. Again, the shareholding structure, it's 100% owned by QVP. Income tax, 30%. But if the liable threshold, which is exceeds, then it is liable, no exemption on this kind of the companies. Then SSCL, which is the liable threshold exceeded, then it's liable. Then this is not the transportation of goods, huh? This is a providing of service. Then it's a, not that is their transport. They are providing of service. Then now come to here. Due to being three companies, the implication of the transfer pricing I need to look at. But this given in the in regulation 1, this A, B, and C application is not given in the pre-seen. Then it should be, if it is tested, it should be in the unseen. Then anyway, Lamai, your quality of reading of the questions, requirements, and your patient at the exam is critical. Okay? Always maintain a quality of reading in any of the subject. Always maintain quality of reading. Then you read it well. Not is it's like that reading one question in the entire 3 hours. No, the quick reading, but in a quality manner. Then here, which is the in a transfer pricing, highlights of the QEP, it's being a group structure. Then the evaluation, there should be associated person. Is that so for us? Yes. There should be transactions in between associated person. Is that so? Yes. Here, the typical example. And from below, one or even a one shall be satisfied to derive a TP issue. If not, even there are transactions, then there is no TP issue. But we can highlight the point. Now, for instance, company A is there, company B is there, or else this Quick Eats and Quick Eats IT is there. The Quick Eats given interest-free loan to Quick Eats IT. It's a simple example I have taken. And there are the intercompany transactions are there. It's a long outstanding, no interest has provided. Then any of this situation, okay, it's not arm's length, I'm agreed. Then what's the impact to the manipulation? What's the impact to the reduction of tax liability? If the both companies tax at the rate of 30% and 30%, then under that situation, it's only the one person adding interest and one person adding the finance cost. But the disaster is in that finance cost. If it shall not be deductible, then there is an issue. But mainly under transfer price and gazette notifications, under regulation 1, this A, B, and C highlighted. What are those things? For you to have the exposure to transfer pricing. Transfer pricing ප්‍රශ්නයක් ඇති වෙන්න නම් to occur an issue in between the companies in the platform of the transfer pricing, the one company shall be exempted and other companies liable for tax. Then we can park the profits. We are always in TP Lamai, what we are looking for how as a group we are going to minimize the tax liability, not as an individual person. Then there should be a link. Then one person is exempted, other one is liable for tax. Easily we can park the profits. The high profits to exempted party and the which is high cost to liable party. The second one, which is the one party is incurring a business loss, or there are carried forward business losses. Another one is not like that. Then the business loss is what? It's a deductible. It's a deductible against one is on business income or in the same or similar business or different businesses. On the other hand, which is under investment income. Then deductible is we can have the tax benefit out of that. That's the second thing. One person does not has the which is on the business loss, then other person has a business loss incurred during the year or the carried forward business loss. Then we can park the profits and we can reduce the tax liability. And the next one, which is the application of the different tax rates, nevertheless, we cannot apply that now. The flat regressive tax rate we have, even everyone, which is the 30%. Then therefore, from this one, the A is applicable and B not applicable. Any difference between income tax rates specified in the schedules in the Act? No, we cannot go for B now. And D, the C, any loss incurred or brought forward losses. If either one is there, there is what? Exposure to transfer pricing. There is exposure to transfer pricing. Then this is the evaluation of the case, which I have done. Then, like in this discussion, implication of transfer pricing, Quick Eats Riders Private Limited and Quick Eats IT Private Limited. Then when it comes to tax exemptions, not applicable. The IT, it was there, not now. Different tax rates definitely not applicable. On brought forward tax losses or business losses or loss incurred during the year by any company, no information provided under pleasing. Then it's there on unseen totally. Then, however, in unseen above information can be provided and test on application of the transfer pricing. Why? This is the that particular sentence, a paragraph, a small paragraph. Quick Eats IT Private Limited. The company was established to provide IT services to the group in addition to providing IT services within the group. Then QE Private Limited provides IT services to other companies. There is a statement given. What is the value of services to other person versus value of services to QVP? The external CUP is there. CUP means comparable uncontrolled price. Then we have controlled transactions within the group. We have uncontrolled transactions in my market, which as a person I'm doing both. And what is the value I'm charging with the independent third party, and what is the value I'm charging with my own companies. Then there should not be a gap between them. Okay. Then that is on the transfer pricing implication. Then application of the transfer pricing issue, the structure, what you have to do. If it is there, the answer structure should be analyzed like this, and which I need to tell, which is in the December 2023 paper. Transfer pricing not tested. June 2023 paper TP not tested. The December 2023, I couldn't remember. Then therefore, anyway, you have to prepare for the 100% syllabus. Huh? But in that, these areas are critical. Okay. Then here, which is the, what is the category of transaction? It's a domestic transaction based on the given information within the group and the in the other independent third party, which the IT company, then it's a domestic transfer pricing application of the section 77. And the transfer pricing gazette notification, I think you have know about the gazette, you have read the gazette, and that gazette is with you if it is required for you to use at the examination. And you may have to recommend transfer pricing method, the very easy way. Yeah? In our case, it's external CUP is there, then comparable uncontrolled pricing method is there. There are 5 transfer pricing methods. And the price at which the transactions in between independent third party recommending most appropriate price. You have to tell what's the most appropriate price for this transaction. Among that 5 transfer pricing methods. How to write the answer? Okay. Then first step, you have to identify whether they are associated person. Our case, yes, due to shareholding structure and the control. And step 2, identify transactions which are having transfer pricing impact with the associated person. And you have to evaluate the transaction, identifying arm's length to the non-arm's length. That's comparison number you have to do. It's only maybe one sentence. In the A Private Limited, the price is this, and within the group price is this. Then it was observed that they have not the selling at the same price which they are selling to independent third party. Then after that, which is the recommend best transfer pricing method, which is most suitable transfer pricing method with a justification. And further, recommend to study the penal provisions and the transfer pricing in the Gazette in Regulation 5. I'm not pretty sure. The regulation 5, the para 5, it is on the penalty, and the para 8 on associated person. Para 1 is on this elaboration on the the application of the transfer pricing. Then please go through that, and again the section 34, 33, 35, which is on tax avoidance scheme, transactions, arm's length transaction in between associated person. Anyway, besides transfer pricing, this section 33, 34, 35, these are very important. Then therefore, it's good if you all know these things also. Then this is on the transfer pricing, the approach to the question. In worst case, there may be the transfer pricing on this particular tax liability before transfer pricing adjustment. Then the transfer pricing officer has identified this should be added. Then that percentage, if it has given, then you have to compute after transfer pricing what's the tax liability and the additional tax liability. It's a just example I have mentioned. But for here, these are the steps on the transfer pricing in the application part of it due to this particular explanation given in the pre-scene. All is due to that. And which is application to the pre-scene, the associated person. Then as per information provided in the pre-scene, based on the shareholding structure and the proposed investments, there may be transactions between associated person. Therefore, as the transaction in between associated person, there may be the transfer of assets in between associated person. After transfer pricing, I need to look at on the transactions in between associated persons in the transfer of assets between associated undertaking. Last time tested, before that tested, in continuously this has tested, and the section 46, the special realization provisions, the section 46. Then here, now come to normal situation. In the normal situation, if there are the two assets are the exchanging or the disposal of the asset or simply the changing of the ownership of the asset is there, then it is the ended up with the recognition of the asset. We have to ended up with the tax calculation. Now, in the recognition of the assets, we have capital assets used for business. We have capital assets used for investment. We have depreciable assets. Then in the normal scenario, you know on all these three assets, how to compute gains and losses. Then on depreciable asset, we have to go for assessable charge or balancing allowance computation. When it comes to capital assets used for business, then it's a consideration minus cost. And again, the section 37, 38 application is there. And again, in the investment asset, you know, the computation of the capital gain. And we have to pay tax on those. Now, if the same transaction subject to conditions, if it has happened in between associated person, what are the tax implications we need to look at? When looking at that tax implication, section 46 plays a vital role, which is covering all kinds of the assets, which is depreciable assets, trading stock, capital assets of the business, investment assets, all the assets it has included in here. Then we will look at what is the implication. Then transfer of assets to an associate or for no consideration. That's a section 46, but I need to go for the subsection of the section 46, subsection 4. In here, where a person realizes an asset, being trading stock, a depreciable asset, an investment asset, or a capital asset of a business, by way of transfer of ownership of the asset to associate of the person and requirement of section 46(5) met. There are a list of conditions which we need to look at under section 46(5). If that met, then how we are going to compute the gain? It's assumed that it's a deeming, these are deeming provisions in there. it's assumed that one person, there are two persons, the person who is transferring the asset to associate person and associate person who getting the benefit of the asset. In that, then I'm transferring to a company, my subsidiary company, then in that, at the point of transfer, for me, it's a consideration equal to net cost of the asset. And for that person also, the associate is acquiring at the net cost. Then the basic computation is a consideration minus cost. Then consideration equal to net cost of the asset. The net cost normally of this asset, if I have taken the property, plant and equipment, net cost is initially the accounting written down value. But net cost is defined in section 195. But very simply, I can say the transfer, the basic transfers we can do at the accounting written down value. I'm talking about depreciable assets. Then in here, the consideration minus cost. Consideration equal to net cost equal to net cost, then net cost minus net cost, gain is 0. That's the situation it has given, but subject to this conditions mentioned in the section 46 subsection 5. The person shall be treated as deriving an amount in respect of the realization equal to the net cost of the assets immediately before the realization. Net cost of the asset, I'm receiving a person treated as deriving an amount. I'm receiving a net cost as my consideration and at the point of immediately before realization, and the associate, the associate shall be treated as incurring expenditure of the amount referred to in above in acquiring the asset. Then they are going to acquire the asset at the net cost. Then, however, both equal to net cost, no gain, then surely we can do this, which is only where the person realizes an asset being trading stock, a depreciable asset, an investment asset, or a capital asset of the business by way of transfer of ownership of the asset to associate of the person and the requirements of section 45(6) met, 46 subsection 5 met, then in that situation, which is a net cost we can apply. However, what are those conditions? These are the conditions. Then this is a continuation of the previous discussion, which is conditions under paragraph in section 46(5). The person or the associate is an entity. Our case, yes, all three entities. That means entity. In the definition of the entity, it includes the partnership, trust, and the company. Then we are in that category. B, the assets, all assets are trading stock, depreciable assets, investment assets, or capital assets of a business of the associate immediately after transfer by the person. Then for our case, all the assets categories are there. Therefore, whatever the asset transfer, we can check whether it's a depreciable asset, investment asset, or capital asset, which immediately after transfer, the associate using in that whatever the category. Then, it's obvious, no? If I have dispose of furniture, the other person also use it as it is a furniture. Then, I'm coming to see in that first one, the person and the associates are resident. Of course, yes. Then in the case of partnership, I'm not coming. The C, Roman 2C, the tax rate applicable on the person's gain from realization of the assets referred to in subsection 4, which we have discussed, is equal or less than the tax rate which is applicable on the gain on the associate from the realization of the asset. Now, this less than story is not there. But this is equal. Everyone now 30%. Then that's satisfied. And D, there is a continuity of the underlying ownership of the asset of at least 50%. Now, my underlying ownership of the asset. You can refer to section 195. which it has given on the definition of underlying ownership. Underlying ownership can be come towards capital and again on the assets. In here, yes, there is underlying ownership more than 50%. If it asset transferred, why it's more than 50%? The reason is this. The reason, where the structure, it is there. The reason is 100% wholly owned subsidiaries. Then anyway, whatever the asset transferred, then it is more than 50% ownership is there. Then therefore, according to preceding information, this condition satisfies. If it is so, there is no gain on the disposal, then no tax implication. The same question it has tested in December 2023, which is your last paper, it has tested. And not only on this one, in the capital gain and in the VAT and SSCL, everything. Lamai VAT in always, we are at the point of the VAT, the value of supply is the open market value or not the net cost or anything. It's open market value. Then the open market value, if we are selling for the person who registered for VAT, then the open market value without VAT is the value of supply. And it is, I'm explaining on the provisions of the section 5 of the VAT Act. And again, when it comes to if the person is not registered for VAT, then the on inclusive price, VAT inclusive price shall not be less than the open market value. Then it is on the tax implication of the transfer of assets with the associated undertakings. Okay. Then that's the one angle. Now again, for 3 companies, the tax perspective possible issues may present in unseen for all 3 companies. Application of case law provision. I don't know, there may be case laws, may not, but then you have to look at your syllabus, which is we have the 5 case laws which we have to learn. And I think you're all comfortable in those. The adventure or concern in the nature of trade, which is identification of the trade or not, capital and revenue expenditure. And third one, which is the expenses incurred in production of profit and income, and the plant and the case law provision relevant to employment income. Now, these 3 and 4 I have highlighted. Reason is the capital and revenue nature, this is not a production type. This is a service level 3 organizations. Then therefore, the capex versus revenue, it's there may be, but not much. In the identification of business or not, there may be, but not much. A plant, again, it's linked with this manufacturing side of like that. But in our model, being a which is a service organization, the expenses incurred in production of profit and income is the one thing. Second one, the case law provision relevant to employment income, there is a drivers in the 2 different angles, the permanent drivers and the which is not permanent drivers. Then therefore, this it's giving little bit of the hints on this too. Key concerns in the expenses incurred in production of profit and income. I'm starting from this one, which in here for this one. Then here, which is Haley, we have Haley and Company versus the Commissioner of Inland Revenue. In this, which we have looked into outgoing of the expenditure, it was on the outgoing of the expense, and again, not expense, it's outgoings. And Commissioner of Inland Revenue versus A.W. David Tapuham is litigation expense on the which is on the confirm the ownership of the shares of another company, and the Strong versus Woodfield, which is payment of the damages. Then these are the 3 case laws applicable for that. And next one, which is in the here, which is expenses incurred in production of profit and income. Now I need to come for that. In the same continuation, I need to come for Haley and Company, because why was the reason? The reason is this. The reason is where the fraud. The details of the intentional misappropriation of funds. It was highlighted in here with drivers, which is not the permanent drivers, that independent type of drivers are there. From them, they have done. Then after that, the fraud, it has happened. It has there. Then can't it be in your question? If it is so, is it deductible or not deductible? With the reason you need to look at. Then that's why this has taken in here the can we deduct outgoings under Inland Revenue Act number 24 of 2017? No. There is no concept called outgoings in there. It's only talking about expenditure. Then no. Information in freezing, which is fraud in page 7, the misappropriation of revenue by drivers joined as independent contractors. And it's a voluntary outgoing, intentionally. Hitamata karapu, it's a fraud, misappropriation of fund. It's a voluntary outgoing of misappropriation of funds. Then such expense not incurred for the production of income of the company shall not be deductible. Then this is shall not be deductible. Therefore, if there is a fraud, if it is quantified, if it has included, it shall not be deductible. Okay, it should be disallowable expense. And next one, which is the case laws relevant to employment income. Now we have 3 case laws with reference to employment income, which is the first one is on the FIP versus Commissioner of Income Tax. In that, the gift received on behalf of the employee, it's a thinking about his medical position. And the Sutherland versus Commissioner of Income Tax, it's gift received, it's a like a ex gratia payment received on behalf of the deceased employee. The employee has death, then the wife of that employee, that particular benefit given. Third one, very which is famous, Kanaka Sabapati versus Commissioner of Income Tax, which is the reimbursement of the medical insurance, which is the main perspective is it incidental to the employment income, is directly relevant, or it's the which is very narrow to employment income. Then come to here, not relevant to all 3 companies, because in all 3 companies there are employees. However, based on the principal business activity of Quick Eats Riders Private Limited, the company manages the fleet of drivers. This is that they are doing driver recruitment, training, management, and the other issues related to drivers are handled by Quick Eats Riders Private Limited. There may be issues in unseen. Apply to current law provision under section 5 subsection 2. What is that? The employment income. In the employment income, whatever the case law extends, you have to apply it to the currently applicable laws under Inland Revenue Act. Then which is the gift received on behalf of employment income, now it's part of the employment income. If employer has made a payment or transfer to third party on behalf of the employee or associate person of the employee, it's a part and parcel of the employment income. Third one, the reimbursement of the expenses on behalf of employee or on behalf of the associate person of the employee, it is part and parcel of the employment income. Lastly, which I am receiving anything to the agreeing on the conditions of the employment is a part and parcel of the employment income. Then whatever is there, you have to link to current position. That's why with the case laws, I don't know what the scenario, what's the question going to be asked, nothing. But I need to link this to current act, which is the underemployment income on the inclusions, which is payments providing discharge or reimbursement of expenses incurred by the individual or an associate of the individual Payment for individuals, agreement to conditions of employment. This is on reimbursement. I have incurred an employee reimbursing. Then the third one, payments or transfer to another person for the benefit of the individual or an associate person of the individual. Next one, other payments including gift received in respect of the employment. Then this is the current application. Then we have, if anything is there, what I need to give the message, link to current provision, not just take the facts of the case and write. You need to take the decision from the case, and then only you have to apply it on the into the current provisions of the Inland Revenue Act. Okay, then here, why these employment income cases are so important? The reason is this. For Quick Eats Riders Private Limited, then as per the in page 6, drivers are one of the stakeholders in business operation. Without them, the riders, without the riders, then which we, there are riders, then this without riders, we cannot do our business. Then here, in that, we have permanent drivers and the independent drivers. Permanent drivers, that's the employment situation is coming. These drivers are they're treated as the permanent employee and are required to work fixed hours during specified days. Their contract with QEP is similar to normal employment contract. Now this is the information given. Then why don't we link to our syllabus, which is in this case law provisions under employment income, whatever matters. Lamai, when it comes to even you are doing the computation, which is the application of the APIT, deduction of the withholding taxes, these are critical. The particular provisions under section 10 subsection 2 and section 10 subsection 2A, which is on the single transaction or per day transaction, that provision is the essence you need to look at. Because these are now currently applicable, the highly applicable things. Therefore, when it comes to salary, this kind of the things, not only the case laws, but again the general things, which is the deduction of the APIT, all that knowledge you should. That's the additional point. Then this is on the how, why the case laws are there due to this reason. And then the next one, which is your favorite part in the question 3, 30 marks, computation. After all possible issues, analyzing of the pre-scene, then the computation. Which my first message to y'all, don't waste time in unnecessary manner in your computation. It's only 54 minutes for you to take 30 marks. 1 mark only 1.8 minutes. Therefore, it's a criminal offense if you have taken more than required time on the questions. It's a criminal offense to you, then your plan you to fail your exam. Don't do that. Okay. Then the practice the questions. There are many past paper questions to do. Practice it and look at the in the company tax. Look at on the application of the computation of the business income, particular provisions, investment income, qualifying payment, and then this is something easily you all can get 30 out of 30. Believe me, you all can obtain the 30 out of 30. Okay. Now let me come to, I'll answer your questions. Okay. Then let me come to other possible tax adjustments, resident company taxation, tax computation in the Quick Eats PLC. Probably it's your company, IT and the riders. I don't think it's there to compute because the P&L and the financial position, everything given on that QEP. Then here, you have to start from profit before tax. If No change in unseen. All figures are millions, huh? Then it's you're struggling with the millions and thousands. Then convert it to thousands if it is difficult. And look at what's given in the paper. In the paper, normally it's this given in millions, but in the paper it's given in thousands. But the income statement given in million. Then here, this is my income statement. Then I have, where is my profit before tax? This is my profit before tax, which is 1,361,000. Here we go. This is that. And let me start from the income statement, not the financial position. We have property, plant and equipment, PP&E, depreciation shall be disallowed. Then capital allowances you have to provide. To provide capital allowances, Lama, you should have to have the knowledge of the section 16 and the 4th schedule, the identification of the depreciable assets, and the application of the number of years on depreciable assets. What is the definition of the depreciable assets? Depreciable assets are assets used for the production of income of business due to using for the production of income of business due to wear and tear and obsolescence, the value of the asset coming up or coming down. Then if it is not the capital work in progress, is not a depreciable asset. If that particular asset, if it is not used for the production of income, it's not a depreciable asset. Then like that you have to think in a different angles. Then let me come to that. Here, property, plant and equipment, capital allowance on disposal, sorry, I have missed, balancing allowance and asset charge. Everything you have to compute under section 14 and the 4th schedule application. When the disposals for year of purchase, we are giving full capital allowances, and the year of disposal, no capital allowances. These are simple points. And the opening capital allowances shall be correctly adjusted with the disposals during the year. Now, as the in the way it's coming and the very suitable way to test your knowledge, which is on the additions during the year given, and you have to apply the knowledge on the capital allowance and what to take, what not to take. And when it comes to opening depreciable asset, these are not the companies just for year of assessment 20 or the financial year end 31st March 2024. No, the long durable companies are coming. Then another situation, which is there are opening depreciable assets. On that depreciable basis, you have to provide the capital allowances in that the previous year capital allowance figure has given. Lamai, remember, in that previous year's capital allowances figure, there is if we have disposed the assets, that capital allowance relevant for that disposal is also included. Huh? If the useful lifetime is fully gone. If not, it has included. Then what you have to do, you have to remove that particular capital allowance which we have charged last year, which we have claimed last year, and this year it's not coming. Then therefore, that particular capital allowance, we have to remove the capital allowances for the disposals during the year if it is relevant. Then that adjustment you have to do. Please practice the past papers. By doing the questions, you have the immense knowledge on that. Then that is on the property, plant and equipment, the possible adjustments. And the right of use assets. Then for this, we have liability. I will take this as that. The lease liability. Okay. In here, then the right of use assets, in that the amortization you have to disallow. Then, which is on the interest cost shall be disallowed. We are not giving capital allowances on the assets because they are not depreciable assets. And finally, the actual lease rental you have to allow. Why? Actual lease rental, it's a reduction of the liability. What we have utilized actually during the year, incurred actually during the year. And for this one, again, rental includes capital plus interest both. That's why that interest charged to P&L we are disallowing. Now come to that, the explanation given in here. Amortization disallowed, interest expense disallowed, actual rental paid allowed, it shall be provided in the question. How to compute? You have actual previous year ROU liability, this year liability, and for that the interest cost you have to add. Then you are getting the what's the rental amount. Don't add on the amortization. Don't do adjustment on amortization. It's a separate double entry amortization expense debit, and it's going for cumulative amortization. Then therefore, which is the, if it is not given, you can compute like gratuity we are doing the same way. And this is on the ROU liability and the asset. Investment property obvious adjustment is the nature of the investment property can be provided. Like in the last paper it has given, which is on is it a asset used for the business or not? Investment property is an investment asset for tax or depreciable asset. Then again, investment property, there are fair value gains, maybe losses, all notional, you cannot tax. Then they are not deductible and you cannot tax. Come to this, which is the next one, investment property. Check the nature of the property, it's a land or building. Based on that, capital allowances shall be granted, which depreciation shall be disallowed. And fair value gains or losses of the investment property charged to income statement under case 4 is charged to income statement. Therefore, if there is a fair value gain, it's a notional. We are not taxing notional entries. This should be removed from the PBT. Fair value losses shall be deductible. Then for this, read information given in unseen. Check what is the purpose of keeping investment property for taxation. Is it capital asset of the business? Is it capital asset used for investment, which is being an investment asset, or is it a depreciable asset? Based on that classification, you should identify the category of income, whether investment income or business income. The crucial thing which you have to do, and you have to take it under business or investment, this asset type classification is important. And that's on the investment property and intangible asset. You need to look at for amortization. In the amortization, and we have to provide capital allowances. If the actual useful lifetime is provided, you have to go with that for amortization, for capital allowance. And if it is not provided, the act was the number of years given. It's a 20. You have to go with that. Then here, intangible assets, amortization of intangible asset disallowed. Provide capital allowances. If actual useful lifetime given, apply that. If not, 20 years is given in the 4th schedule. That is on investment, the intangible asset. And next one, investment in subsidiaries. Of course, we have two. There may be the impairment, diminishing of the values of the subsidiary investment. If it is so, then that particular adjustments we need to take. Sorry. Then in the investment in subsidiaries, in any case, gains or losses, the impairment charged to income statement, these are not allowable deductions. And when it comes to financial assets, then other financial assets, there may be fixed deposits, treasury bills, and I will come to those later. And the next, this is on the possible adjustment. I'll go through these things quickly. That there may be inventories, but we are service level organization, but there may be inventories. Then inventory write-off, it's an allowable deduction. Inventory provision disallowed. Continuously tested this provision in your papers. Trade and other receivable possible adjustment. Trade debtor written off. If there is a trade debtor written off, what you have to look at? Whether the legal actions obtained or not. Then, if the legal actions are obtained, then I'm so happy. it is allowable deduction. If it is not obtained, then it shall not be deductible. Then trade ledger written off, check whether legal actions were obtained or not. If obtained, allowable. If not, disallowable. Provision for bad and doubtful debt. Any provision with charge to income statement, we are transferring an amount for the future which is not yet incurred. Then these are notional. Therefore, under section 10, subsection 2b, subparagraph 8, this should be disallowed. Then that provision for bad and doubtful debts disallowed. Legal expenses, now it's in the bad debts recovery, there may be that. Then legal expenses incurred on debt recovery, allowable deduction under section 11, but I need to write, but subject to section 10, subsection 2. What is this section 10, subsection 2? In legal expenses, if we have obtained the legal consultancy fee or the consultation from the resident individual, if the payment is more than 100,000, what's the withholding tax application? It's a 5%. Then if that 5% has not deducted, even it has incurred for section 11 requirements, can we deduct it? No. Then those things you have to comparably you need to look at. Then the amount due from related party. In this, our question, which is amount due from related party, is there amount due to related party? Yeah, amount due to related party is not there. But there is amount due from related party. In the amount due from related party, if there are written off, it shall not be allowed to deduct. Check the nature and the purpose of receivable and the application of arm's length. It shall not be at the in the zero interest or in the less than the market acceptable values which we need to take. Then application of arm's length pricing. With reference to a change in of interest rates, and there may be fund transfers, reimbursement of expenses like that. Any written off in the which is amount due from related parties. Now there may be recoverable. Then in the IT companies telling I cannot pay that. Then if there are written off, it shall not be deductible. Then the next, which is the other financial assets, the possible adjustments, treasury bill investment, fixed deposits, then like that. Treasury bills, what's the point which you have to remember? Being a secondary market instrument, treasury bill, is it subject to withholding taxes? No. Under section 84, subsection 3, very clearly given the exclusions on the withholding taxes. Then WST not subject to 5% of the withholding tax. The treasury bills not subject to treasury bills not subject to 5% of the WST. Therefore, when doing the computation, either treasury bill 5% apply, don't bring into the tax credit. Okay. Then here come to this in other financial assets, the treasury bill investments. Interest income shall be recognized under investment income by removing from the profit before tax. Note that no WST applicable on secondary market instrument under section 84(3). Interest on FD shall remove from the profit before tax. Gross interest income I had to recognize in the investment income, and the 5% WST credit shall be provided, but subject to exemptions. In the FD interest, it's an examiner given. The foreign currency FD interest of ₹10, which is 5 million included in there, you cannot tax that. It should be exempted. And let me take which is subject to exemptions. Okay. And next, which is the invested in listed shares, you know, it's the dividend income, it's a final withholding at the rate of 15%, and dividend distributed out of dividend income exempted. And again, if this listed shares disposed, it's exempted. Okay. Then it's exempted, and if there are fair value adjustment, if there is a gain, we are not taxing. If there is a loss, it shall not be deductible. This is on that. And the the other income. In your income statement, there is other income. In the other income, then here, which other income may be included, which is examples, the dividend income. The dividend income I have explained many times, and I'm not going to tell again, which is removed from PBT, identified under investment income subject to exemption. Rent income. Rent income, there is the withholding tax. First rate, 10%. At which occasion it's applicable? The rent income shall be exceeds rupees 100,000 per calendar month. In which situation, then we have to give the rent, the property, to conduct a business, not for residential accommodation purpose. Then that details given. If it is so, then you have to take the 10% as the withholding credit. But that's not the important point. Anyone can do that. What you have to look at, you have to analyze the type of the asset. Whether this rent, is this effectively connected to the business, or this is an investment income. That differentiation you should have. Then for this note, check whether investment income or business income. Is this effectively connected to the business? And any expense incurred for rent income under investment income shall not be deductible from the business. If you have a look at the last time paper, the December 2023 paper, it's a one requirement. Under business income, you have to compute rent income as a separate business income. Then in that, whatever the expenses incurred in the profit before tax, which we have deducted, you have to take it separately. Even in the investment income, same thing. What you have to do, you have to remove that particular expenses. It is deducted, you have to disallow it, and you have to take it separately under rent income, whether it's a business or investment. Then, now the last time it has mentioned to take it as a separate business unit. But if it has not given like that, if it is effectively connected to the business, then you all can deduct and include the income in the same as the business when computing the business income. But if it is investment income, anything which deducted in the expenditure with relevant to investment, we cannot deduct when computing business income. Then here, profit from disposal of PPE, it's removed from the business income. You have to compute balance in allowance, so assessable charge. And the next, other income again may be include the disposal of shares. It's a listed entities, it's exempted, and which is the we have to remove from business income if it is relevant to investment asset, then which is it may be capital gain, then exempt or liable. Accordingly, we have to apply the correct in the tax rates. Exchange gain losses, the realized gains. Now we have realized business gains due to the settlement of the foreign creditors, due to receiving money from my foreign debtors. Then like that, then realized gains are part and partial of my business income. The realized losses can be deductible. When it comes to unrealized, now I have to convert my trade debtor, foreign debtor at the closing rate, the creditor. Conversion of the long-term loans in foreign loans. Bank, which is cash and cash equivalents. The conversion of the foreign currency denominated accounts. Like that, these are translation. Due to the translation, we are ended up with the which is unrealized gains and losses. Unrealized exchange gains, we shall not be taxable it shall be removed. Sorry. Unrealized gains, let me take gains. Unrealized gains, then it's included in profit before tax. I had to remove it from PBT. Unrealized losses, it has deducted from PBT, then I have to disallow that. Okay, then add back again. Then this is on the exchange gains or losses. We have realized gains, part of the business income. Realized loss is deductible. Unrealized gain, not part of the business income. That means we need to remove that, and the unrealized losses shall not be deductible. Okay, this is on that. And which is in here, tax perspectives, other possible adjustment as the whole. I'm taking 10 minutes on giving these explanations. Accounting loss of disposal of PP losses, it should be added back. Accounting depreciation, amortization, it should be disallowed. Inventory written off, it's an allowable deduction. The doubtful debts, general doubtful debt provision, which is on the specific provisions or general provisions, whatever it shall be provision disallowed. Then any employment benefit under fair market value and considered for employment income. If it is not considered under fair market value, that gap under domestic expenditure we have to take. Then for example, which is the CEO has provided a vehicle. Then vehicle, fuel and driver. Then it's a 50,000 per month. Then instead of 50,000, he has just taken to his employment income only the value of the vehicle, which is 20,000. Then thereby, since it's the value of the driver, since it's a value of the vehicle, then since it's a 20,000, then 30,000, there is a gap. The company shall not deduct that or entire 50,000. The 30,000 which it has not tax under CEO's employment income. Then there is a gap. That gap should be disallowed. It's everything is given in section 197. Then any written off amount of the related party disallowed, it has explained. And which is administration, selling and distribution expenses continue. These things, Lamai, I have explained one by one. The finance cost explained, and the improvements charged to income statement, if any, you have to apply for section 14, which is subject to section 11. In here, which is the section 14, which is improvement expense. In the application of the improvement expense, we need to look at on what? We need to look at what's the type of asset. Is it a class 4 asset category or other than class 4 asset category? If it is a class 4 asset category, which is a building structure in the permanent nature, then you need to take what? You need to take the previous year's tax written down value, and from that previous year's tax written down value, 5% as the maximum limit. And you have to compare it with the actual improvement and take your final quote as a disallowable or allowable the gap. For other than class 4 asset categories, which we have the 20% of the previous year's tax written down value. ඒක නැත්තම් කියන්නේ, which is if the previous year tax written down value is 0. If you have purchased an asset in 2018-19, what's the current position? Entire 5 years capital allowance is given when it comes to 23-24. Then my previous year's tax written down value is 0. What should I do? Then for that, in the amended Act number, which is 45 of 2022, it has given the provision. What is the provision? It's given for a class 4 asset category. You have to go for equal proportionate of the 12 years. The actually incurred improvement cost, I have to divide by 12, or actually incurred improvement cost, I have to divide by 3, which is on other than the class 4 asset category. Then that's on the improvement adjustment. Marketing and communication expenses, there was the additional deduction under 6th schedule. It was abolished from 1st April 2023 onwards, no more there. Same thing on the R&D expenses. You have to apply on the section 15. The additional deduction under 6th schedule is not there, abolished from 1st April 2023. And the comfort this. I don't know, it may be wherever in your paper, this is one of the new adjustment which under section 10, subsection 2A, practically highly applicable now. Then, which is in the deduction of expense or acquiring asset in the single low per day transaction, if which is the amount is the aggregate amount to 500,000 or more. Come to this, what is implication? The tax implication of non-deduction of the first thing, non-deduction of the relevant withholding tax on expense. I have explained it. It shall be disallowed. Always you have to look at that. Second one, which is non-application of section 10(2)(a), which is the restriction on payment per day or under the single transaction. Effective from 10th May 2023 under section 10(2)(a) from the Act number 4 of 2023. What it has given, a sum of money amounting in aggregate of rupees 500,000 or more in a day or in respect of a single transaction or in respect of series of single transaction relating to one event otherwise than by way of an account pay check or account pay bank draft or by the use of a credit card, debit card or electronic payment system through the bank account. Then we have to use these methods to make the payment if the aggregate in 500,000 or more per day or single transaction. What is the prohibition? Prohibition is a cash payment. If we have not made my transaction in a debit card, in a credit card, online, account pay check, whatever bank draft, what is the consequence to me? The consequence is the deduction of expense shall not be allowed, and if we have purchased an asset, the asset shall not be considered as an asset for tax purpose. Then if it is not the asset, what's the main disadvantage we have? It's the claiming of the capital allowances. Anyway, expense we have to disallow. Then here, which is prohibition, due to that, any deduction shall not be allowed in respect of such payments in calculating the first mentioned person's income. The expense shall not be deductible. And the second one, the amounts paid shall not be considered as the cost of the asset. Then the disaster is on the capital allowances. Check the application to your unseen regarding reading it carefully. This is one of the new provisions. Then don't take a risk without knowing these provisions. Okay. Then that's why including that act provision, the separate theory part it has taken. Then here in the provisions of above para, it shall not be applicable to the payment of the government. And for all these things now, I think you know, other than the cash payments and the online payments, in the taxes covered under Inland Revenue Act, we cannot make the payment. Then this is correct. And what's the meaning of the single transaction? Means the purchase or a procurement of any goods or service on a single invoice or receipt or statement. And this is on the new provision. Please go through this. It's very, very important. Then, which is finance cost adjustment. I have done this, Lamai. Then, therefore, I'm not in the way of financing. I have done this. Then, I'm not going to do this again. And the gratuity provision. Easy thing, provision given, payment given. In any case, if the payment is not given, you know how to compute it. Then gratuity provision should be disallowed. And payment allowable deduction. Then compute the payment of gratuity. Take in the information provided in the pre-scene as well as the unseen. These are the pre-scene information. Opening given, closing given, provision deal and payment not given, and the actuarial there is a loss it has given. Then if the provision is given, easily you can compute this one, which is the payment. Okay. Then that is for the gratuity. And next one, which is in here, finance income. Again, this has explained for treasury bills, the 5% WBST not there. What you are doing, Lamai, the application of the withholding tax, you will forget at the exam. Then please do those once the one adjustment done. If it is FD interest, party is exempted and party is liable, remove it from the profit before tax, include it on the investment income as exempted and the liable, and for the liable part, take 5% and go for tax credit and deduct that. Don't take into the, which is in repetition, reduce the repetition in your examination. Then that is there. And lastly, which is on the income tax case laws and statutory provisions under VAT Act and the Inland Revenue, these are compulsory anyway. You need to know about assessments, time bar provision, even Inland Revenue Act and the VAT both. The assessment, time bar provision, appeal, penalty, return filing, payment of tax, everything you need to know. Okay. Then this is the end of the discussion. Then it's time for Q&A. Then this is typically end of the discussion of your pre-scene applicable for June 2024 examination. Everything which based on the information it has covered. Then I think now I can go for questions of you. I will stop share. If it is required again, then I will share the document. Then let me come to this. Okay. Then let me come to the questions. Capital gain tax rate on disposing of private equity shares is 10% or 30%. Then we have look at on the individual perspective. Let me share this again. Individuals 10, companies 30. Yeah? Then the disposal of shares coming from the individual angle, not from the company. Then if that means the two shareholders, they are selling their shares. Then that's why we have taken the rate of 10%, individuals 10%, and for the companies it is the 30%. Then this is the disposing of private equity liable for income tax at the rate of 10% under capital gain. I am very clearly given is for individual income tax, not for company. Yeah? This is for resident individual. Egolangi shares vikulani for their shares is disposing. Then therefore it is applicable for the individuals 10 and the company it is the 30%. And can you elaborate more on the application of ROUA and the finance leasing tax perspective? Of course, when it comes to, I will share this again. Then when it comes to the document, in here, okay, when it comes to right of use these assets, in here, these are the adjustments you have to do. The adjustments are, there are amortization expenses. In the amortization, which is charged to income statement, you know, It's very easy. Amortization should be disallowed. It's a kind of the provision, what we are doing. And the second one, which is only the ROU interest is there. ROU liability interest. Because we have the liability and the corresponding asset. Then in liability, then that particular finance cost we have to disallow. Why we are disallowing finance cost? We have to allow or we have to deduct the actual lease rentals paid. Then actual lease rental paid we are allowing. In the actual lease rental paid we have two components. One is the interest, other one is the capital. Then the interest in the room of the rental, interest is again deducting. Therefore, that interest which it has charged to income statement, it is disallowed. දෙපාරක් අඩු වෙන එක නවත්තන්න තමයි disallow කරන්නේ, which it has charged to income statement. If not, it's twice deducting. In the sense of the rental and in the sense of the finance cost, it's already deducted. Then the finance cost, under finance cost, the finance cost relevant to ROU, then we need to disallow, and the lease rental we need to allow. And the next thing is the capital allowances we are not providing because it's not a depreciable asset. We have only right to use, not the ownership, only right to use we have. Okay, I think that that one is enough. Then the next one, please share the document. Sure, I will email this. And the next one, which is if resident company doing export and that income received in foreign currency to Sri Lanka bank account within 6 months, is that income is exempt still? No, there was no exemption like that. This 6-month provision is there for the value-added tax perspective. Then it's for the identification of the zero-rated supply and the disallowing of the input VAT. Allow or disallowing the input VAT. Then when it comes to this, your question is resident company doing export. The export, it's liable at the rate of 30%. For exports, we don't have the exemption. If so, the exporters are so happy. No, the exports, there is no exemption. The two common exemptions are there under third schedule, which is the first one. If we have provided a service to the person outside Sri Lanka, I will on my video because it's here, which is the person providing services to another person outside Sri Lanka and utilize outside Sri Lanka by that person, and the income is received in foreign currency, then it is exempted foreign currency to the bank account. It is exempted from the income tax. This is the third schedule, subparagraph U, subparagraph 3, I think. If there may be mistake, then for sure it's in the third schedule para U. Then it is exempted. And next one, if I have a foreign business, from that foreign business, then the Sri Lanka I'm doing business and Bangladesh also doing. From that Bangladesh business, if I have received in foreign currency through my bank, that foreign business source, it is exempted. The service income subject to utilization outside Sri Lanka, and the foreign business source, it is subject to that too. Both are in the third schedule para U. Other than that, for exports, we don't have exemptions. The export company is liable at the rate of the 30%. For VAT, it is the 6-month provision is there for us to consider it as a zero-rated supply and claim the input VAT. This 6-month provision is there. From the 6 month we are counting from the date of the invoice. At the end of the taxable period we need to count. Okay, I think I have given the answer for that. Then that is on your explanation. Any questions? If you don't have any question, the common question, this PPT I will share. Then they will do the necessary arrangement. And the, I will share this. And tomorrow I think we have the mock paper discussion. If you are available, if you are not going to visit the Dansala and all, then you all can join for the mock paper discussion. Then I think it's good for you all. And please go through what we have discussed. And if there are gaps, please look at your syllabus. Now it's 20th. For tax paper, we have another 9, if it is. So it's 8 days are there, more than enough. Then therefore, please effectively manage your time and do your activities. I think there are no any questions. For that, then if it is so, can I wind up the session? Then anything I'm inviting you to, which is on, again a question. Is thin capitalization abolished? No. If it is abolished, we are the most happiest persons. No. It is still there. The concession is given after first year, which we are in good terms in the first year in after COVID, which is in 21-22 year of assessment under 6th schedule to not to apply for section 18. Then it is no more. Then it was it is there, and which is stated capital plus it serves into 4 times. Then done. Any questions? Because all the time I'm going to stop. That's a question. Then if there is a question, I can answer. If not, leisurely I can wind up. I will send this. Madam, need to done solar relief for company. No. The solar reliefs are applicable for resident individuals, not for the company. The relief, please remember, we have 2 deductions from my assessable income. The gap between assessable income and the taxable income, we have 2 deductions. One is a qualifying payments, other one is a relief. Reliefs always applicable for resident individuals. We have 3 reliefs. One is 1.2 million of the tax-free allowance. Second one is 25% of the repair allowance on the rent. The third one is your so-called the solar relief, which is maximum per year of assessment is a 600,000 out of my solar investment, out of my loan, or out of my cash in hand, which I have used. Then it's up to 600,000. Below not kamak ne. It wadi adu not kamak ne. It's no matter if it is less than that, but maximum I can claim. It's only 600,000. It's not applicable for companies. The relief removed from the companies, relief only applicable for individual taxation. Again, with reference to resident individuals. Then, okay. Then I will wind up the session. Thank you very much for effective participation. I think it's helpful for you all. And please go through whatever the things, the knowledge gap you have to reduce. And you have to do your exam in 3 hours and 15 minutes. Your open book referential materials and everything should be with you. And you should be a smart student. At the exam, it's a 50 marks. All of you all can take that. Then to this 8 days, please do the things on that, whatever the subjects you all do. Okay? I will wind up the session. The financial institutions, but questionable, of course, yes, why not? Please look at, but on financial services, after July 2022 exam paper, it has not tested. Please go through the new gazette notification is there, incorporating SSCL on financial services. The calculation method is there. If it is tested, how you're lucky. Please go through the kind request, which is whatever the Baton Financial Services are very, very important. After July 2022, it has not tested. Then go eye-opener with that area. The Gazette is there, calculation. You can purchase on July 2022 paper, question 2, part A. Please look at and go. Madam, if time permits, please can we give you a suggestion? Is it good to start with 30 marks question? Anedaru, I cannot give suggestions on that. It's your thing. It's your matter. If now it's not you. If I was a student now, then if I'm doing SL3 paper, then at the 15 minutes reading time, I'm selecting the question which is most, which is accessible question to me, most, which is feasible question to me. Within that time, if it is, I have selected that question, what I'm doing in the reading time, in the 15 minutes, or if I thought that, think that it's 2 minutes gone, then balance 13 minutes, I'm reading the requirement of the question. It's me, not you. I'm reading the question and I'm going for the facts of the question. I'm going for my answer formats. And once the answer booklet received, I'm starting with that question. Answering of that question is the question which I am 100% familiar, because I need to start my paper with positive thinking. Then I'm selecting most attainable question to me. That's me. Then I don't know about you. Then I'm not giving instructions on that kind of the qualitative factors. It's totally based on your cognitive biases, Lamai. Then on that, how your perception is going, how can I give the advice? Then, and again, sorry for that, I cannot give a direct answer, but I know it's a 3 hours and 15 minutes, and I know I have to pass this paper, and I know more than time permits. If I have utilizers, I'm going to fail this exam with all these intentions. I'm doing the paper. Then that's the final advice on your question, which is with reference to starting of the 30 marks question. It's a 54 minutes, and the disaster is in that if you write in your paper 54 minutes, then at the 54 minutes, you know, okay, there is alarm in your brain. If I use more than 5 minutes from this, if it is 60 minutes, 1 hour gone. If I have done more than this, I'm going to fail. If that alarm is in your head, do it and complete. If the relax from the paper, 30 marks I have done, then it's relaxed. The pattama tiyenawa, I have just given on my, as the financially being student, I have done the explain, I don't know on this, it's based on totally on your perception. Then I'm not telling, I'm going to end this. Then, okay. Then if it is so, shall I wind up? It seems to be everything okay. Then I will wind up the session, and tomorrow there is a mock paper discussion. If it's time permits, please join in. It's whatever the questions, improve it before your examination. Thank you very much. I will wind up the session. Good night for all of you.